Hello and welcome to our special series, The London Eye. My guest today is another emerging markets veteran, Edward Evans, Portfolio Manager and Chief Investment Officer of Ashmore Investment Management. He runs $5 billion in emerging markets, out of which $1 billion is in India. Edward, thank you very much for joining in today for the series. I want to ask you first how things are with the perception about emerging markets, particularly after the recent bout of strength in the dollar and the bout of volatility that we've seen in 2018. Have people been ruffled, or are they taking it in their stride?
No, it's a good starting point. I think emerging markets have suffered from a prolonged period of negative sentiment, which plateaued in 2016 and started to recover in 2017, and that's really continued year to date in 2018, and that's reflected by fund flows. So industry level fund flow data has continued to be sort of net positive. You're right, in the very recent term you've had quite a few bouts of elevated volatility, stemming all from developed markets, which has caused volatility to pick up. But I think emerging markets and flow data is continuing to point to investors picking off opportunities to increase their exposure.
There's no rush to redeem or anything like that, to take some of the profits of the last couple of years, or are people using these corrections to actually deploy more for cash?
I mean, it's difficult to get too much colour of the industry data, but if I think anecdotally on the desk, institutional investors are very cognizant of the fact that emerging markets have been under-owned over the past couple of years, and there's been a lot of a structural change in investor views towards emerging markets, so they're adding more money to take advantage over the short-term volatility. Let's call them retail intermediary investors, do tend to be more sort of quick in their response to periods of market volatility. And if you look at passive fund flow data, then that does point to a more volatile series of flows.
So you've got nearly $5 billion in emerging market equities, and
yes,
$1 billion of that is in India. But we are not getting, I mean, the anecdotal evidence is that foreign flows into India are not anything much to cheer about. Why do you think that is the case? I mean, are there local factors specific to India which is clouding the picture?
In the very recent term, India's been impacted by global challenges. Let's put that down as sort of concerns over the sustainability of global liquidity in US dollars, and at which is sort of very much piqued investor concerns, and that has impacted India because India has a current account deficit of around about 2%, and of course higher energy prices are putting pressure on your current account deficit. So there's quite a focus by the market looking for areas of vulnerability. Of course, locally, at a more domestic level in India as well, there's been some challenges, in these very structurally long-term positive reform measures are taking time to have their positive implications, ramifications. So I think over the very near term, India has seen the brunt of sort of volatility of flows. Let's not forget the Indian stock market was up, 38% last year. At least the MSCI India index in dollars. So I think some investors may have taken some profits while they then look to readjust their positioning.
Would the rupee be an additional worry factor for a lot of global investors like you?
I think the rupee's seen pressure given my comments around the current account deficit and so forth. It's at the minute there's a focus globally on currency pressure, and it's very important to take a few steps back and think of it as it's starting, I think, with investors generally taking profits of the euro versus dollar after the strong move in the euro against the dollar, and that sort of morphed into taking profits in also emerging market currencies which have performed well. But also picking out certain markets, certain countries, and Turkey and Argentina are the obvious two, which are more sensitive, more vulnerable to a reduction in global liquidity.
Where does crude oil come into the picture? Because that's another issue which hurts the perception of India, the sentiment towards India. But how does a fund manager for emerging markets take the price of crude oil into its portfolio strategy?
Yeah. We're not an energy specialist, and unless you're a commodity specialist firm, one tends to avoid putting a price on a barrel of oil. You can sort of think in more range bounds, but you don't base an investment decision on what the price of a barrel of oil will be tomorrow. If I think of our sort of stock holdings and our focus in India, it's far more on structural changes. It's far more on the beneficiaries of some of these reform measures that have been slowly but surely carried out over the last several years. So the banking sector is an obvious beneficiary of a lot of the changes that have happened. So the focus then is on those more certain areas where we have increased visibility than something like an energy price.
You alluded to this whole business of shrinking liquidity in the world per se, obviously also for emerging markets. How do you see EM equities perform in a scenario like this, where overall we know that balance sheets are shrinking by the central banks?
Yes. We're in an episode where developed markets are trying to carefully unwind exceptional monetary policies put in place essentially post the financial crisis. And that is not an easy task, and you're likely to see it as a source of volatility as we continue. For emerging markets themselves, though, they actually benefited from their currencies weakening, becoming a lot more competitive post, for example, the 2013 pressure on currencies. That's enabled emerging market countries generally to run far tighter, stronger balanced economies. So the pressure of a reduction or a deceleration in abundant global liquidity is far less of a stress today than it was, for example, back in 2013 when the notorious taper tantrum happened. Now, of course, that's a generalised statement. There are exceptions to every rule, but generally emerging markets look far more credibly based in that sort of circumstance.
Will you go as far as to say that maybe it's a cycle of 5-6 years that we may have entered about a couple of years back in emerging markets, or do you think it's still stop-start, a couple of good years, one bad year? We still can't call it a proper cycle.
I think emerging markets have started a stronger cycle, and I think if you want to pinpoint the period it was in, sort of 2016, as you know, ultimately earnings are your sustainable driver of emerging market returns, and earnings reflect, if you like, where you are in a cycle. And of course, after a prolonged period of negative earnings expectations, it plateaued in 2016. It recovered strongly last year in 2017, which incidentally meant that the strong stock market move you had was very well supported, and it's continued in 2018. And I think the key focus for a fundamental manager such as myself is following the earnings progression. So earnings expectations are higher, so it's more challenging to beat those from a simple mathematical higher base effect. But so far, at least in local currency terms, you are seeing those higher expectations being met. Earnings are also notably strong, broad-based across countries and also industry groups. So it points to an overall quite a constructive view on emerging markets.
But on earnings, are you happy with what's come out of India? Because there seems to be an air of disenchantment if you look at aggregate earnings. In 2017, India did not quite deliver as much as some of its other EM counterparts.
Yes. Expectations for earnings in India in 2018 are the highest it's been for several years. And what's driven that is expectations in the banking sector. I think it's fair. There is, investors want to see the structural changes implemented in India having a positive ramifications, so expectations are strong, and I think one will need to be selective within, as you would in any country, within those earnings expectations.
How do you read the banking sector in India? Because the corporate banks still seem to be struggling. There's a lot of news flow about scams coming out of the public or the state-owned banks. Where do you stand with Indian banks relative to other EM financials?
Yeah, India's got some very high quality, more private orientated banks which continue to grow from strength to strength and take advantage of many of the positive hallmarks of a growing emerging market country with great demographics. The public side clearly is going through a period of change. The bank recapitalisation is certainly helping. But still, again, one needs to be selective within that. I think overall one could point to the banking sector in India as having stabilised its pool of poor loans. I think as the economy is recovering, which it is, that will also make the NPLs and non-performing loans a less important part of the focus of the market as economic growth is recovering. And of course, things like the bankruptcy protocol process, which is currently being worked through, that is also, I think, a net positive. So overall, it's quite a constructive view, but one needs to be wary that it will take time for these positives to really come out, and one needs to be selective between the banks.
How much of it is in the price now? Because we've had a couple of years of reasonably good performance in emerging markets, including India. Mm-hmm. What is the price capturing now, Bob? Do you think it's ahead of earnings growth, or do you think there is still some room for prices to expand as earnings kick in?
Yes. One of the challenges as an emerging market investor in India is the valuation, because of the potential for India to perform, because of the potential for India to really fulfill its promise. As a poster child for emerging markets, you tend to have to pay up a high valuation, a high multiple for that. At the minute, the MSCI Emerging Market Index is on just below 12 times next year's earnings. India's on somewhere between 17 and 18 times next year's earnings, but the earnings, like I said, have improved. So expectations are for over 20% this year. So on that basis, valuations are supported. And indeed, valuations versus history look better. But again, it's not one size fits all. So we spend a lot of time really sort of getting to know businesses extremely well, the challenges they face, and how quickly they benefit from these changes that are happening in India.
We'll take a quick break now. Back with Edward Evans of Ashmore in just a minute. Don't go away.